Doing, guys? Can you hear us okay? All right, we got a yes from Lemuel, Chris, FW, Nelson. Thanks, guys. All right, welcome to the webinar. Thanks again to Nadex for having us. My name is Bob Iacchino from Path Trading Partners. My co-founder and constant conscious, Mike Arnold, is here as well. And this is Trading in the Money Nadex Binaries. You're going to learn some interesting stuff here about some preconceived notions about reward to risk that you see in your Nadex ladder, your Nadex order tickets, and things like that. So let's get started. But before we do, as always, I don't want you to read this. I'm going to read it to you because we take this part very seriously. This presentation is not for information purposes only. I'm sorry, it is for information purposes only. And does not constitute investment advice nor an offer, solicitation, or recommendation to acquire or dispose of any investment or to engage in any other transaction. This presentation is not intended for solicitation purposes, but only for use as general information. All descriptions, examples, and calculations contained in this publication are for illustrative purposes only. The risk of loss in trading can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial conditions. Past performance is not indicative of future results. I always read that to you guys rather than just tell you to read it because it actually is important, even though Nadex is a great place to control your risk because they have the built-in risk controls and the built-in targets, which we are big fans of. It is not necessarily up to them the amount of money you risk. So when you risk too much money in a trade, there's nothing Nadex or anyone else can do about it. So please, please, please be very careful about the way you control your risk. All right, learn a method to control your risk. We have those, some other good people have them, and make sure that what you're doing fits in with what you're able to do. So who is Path Trading Partners? Path Trading Partners is a trading and education firm. PTP's mission was to form a trading firm that educates, supports, and backs traders who are committed to probabilities, discipline, and long-term trading success. This is achieved by following the correct path. We are not high-frequency traders, and we are not day traders. What we are is a firm that believes in a long-term success in trading, covering time frames dictated to us by products, markets, and price action. What I mean by that is we don't walk in the morning and decide this is how I want to trade, this is the contract I want to trade, this is the time I want to trade it at. We have strategies, methods, processes in place, and we take what the market gives us. Some days for us there are no trades. The market's not giving us any. Some day there's a lot. Some day we lose, some days we win. But overall, we win more than we lose, and we make more when we win than when we lose. Lemuel asks, how do you know it's guaranteed risk? Lemuel, at Nadex, you cannot lose more than is on the maximum risk of your order ticket. That's one of the good things about Nadex, besides the fact that they're CFTC regulated. So when you trade on Nadex, the only amount you can lose when you place a trade is the amount that is on the maximum risk corner. It's usually at the bottom left corner of your order ticket. So you can't lose any more than that, unless, of course, you place more trades. So that's what I mean by that. So who is Mike Arnold? Mike Arnold's a 24-plus year market veteran who has been teaching traders online and in person for 10-plus years. That is his oddly handsome face at the top right. Mike is a strategy and development consultant to multiple hedge funds. I like to kid around that Mike is a professional devil's advocate. That's what he does for a living, besides what we do here at Path and besides his trading. A hedge fund will come up with a trading method, and then they will hire Mike to break it. They'll hire Mike to find the problems in their method and tell them what's wrong with their method and why their assumptions may be incorrect. He's a former options market maker on multiple exchanges. He has traded in Chicago, New York, Switzerland, and Canada. And he is the current head of technology and trading systems development for Path Trading Partners. That is my reasonably interesting face on the right, along with Becky Quick. I've been around for about 24 plus years now, commodities, futures, and Forex markets, and I've been teaching and mentoring traders both live and online since about 2002. I've mentored over 5,000 students at this point. I think we're approaching about 6,000 now. What I bring to you guys is I've been an analyst, a proprietary trader, and a fund of hedge funds principal, as well as being a member of the investment committee at that fund of hedge funds. That's what I bring to you guys. I've analyzed virtually thousands of managers trading returns. And one of the things we focused on at the fund of hedge funds was the performance of traders during losing streaks. Again, that's the most important part of a trader's development, is not only how they handle gains, but how they handle losses. Sometimes the euphoria of a gain can be way more damaging than the despair of a loss. But if a trader starts trading differently during losing periods, that's a red flag for a fund of hedge funds. I've appeared on basically every business channel along with a couple of regular channels, and I still continue to appear about 5 to 10 times per month. I am one of the CNBC Futures Now traders, so you can catch me on that sometimes once or twice a week, and I've done over 700 interviews on various topics to this point. So enough of that. We often reference prior classes excuse me, when we do a webinar, and just so you guys can find where those prior classes are, I'm going to put up nadex.com here because I'm going to reference some of the stuff in the prior classes. So you can see on your screen in a minute, there it is, nadex.com. You go to the Learning Center and you go to the Webinar Archives. Now if I had my way, you would filter by presenter and only watch our stuff, but that's unrealistic. But here is a list of some of the prior classes that I just referred to. So when we refer to the prior classes, that's where you guys can find them. But as I said, in a prior class, we covered the concept of moneyness and classifying a Nadex binary option as either out of the money, at the money, or in the money. And we taught the Greeks what they are, how they apply to Nadex binary options, and how they can help the binary option trader understand the binary price movement and price changes due to theta and vega. If you don't understand why your option is moving in price the way that it is, the Greeks help with that quite a bit. Again, if you need to learn these concepts, please watch the recordings of our prior Nadex binary classes after this particular webinar. I showed you where those are at. After learning the Greeks, most traders wonder how they can effectively translate that knowledge and information into useful and actionable trading information. Well, that's precisely what we're going to do in this class when we look to trade Nadex binaries that are in the money. However, first, we're going to do a very brief review to ensure everyone is on the same page. It's going to be a lot of information, part of the reason this stuff is recorded. So, binary options review. Binary options are worth either $100 or $0 per contract upon expiration. So for every contract you do, you're either going to make $100 or you're going to get paid back $0. That's $100 minus what you paid at expiration. If the Nadex settlement index is above the strike price of the binary option, then it's worth $100. However, if the Nadex settlement index is equal to or below the strike price of the binary option, then it's worth $0. Out of the money versus in the money, which is what those two abbreviations mean. We refer to a binary option being out of the money if it's trading below its strike price. That's it. So if you've got a 2010 US 500 binary option, it's listed as greater than 2010. Okay? If it's trading below, it's out of the money. We refer to a binary option being in the money if it's trading above its strike price. So same example, a 2010, for example, being above 2010, it's in the money. A binary option is at the money if it's trading right at the strike price. So same example. For the purposes of this course, since we consider at the money binary options to be out of the money, since they are worth $0 if the Nadex settlement index settles right at the strike price. So what does that look like on a graph? All right, so in the money, again, that 2010 strike binary option example. Okay, the underlying price down here along the lower axis, and then the value of the option up here. At the money would be right here on the 2010. Okay? So this is sort of the price movement with about 30 minutes left to expiration. They all end up at either 0 or 100. But with about 30 minutes left to expiration, the curve of value looks more like this. Okay? It doesn't mean that when it goes to 2011, it's automatically worth 100. That's not the way it works. Okay? And that's some of the things we're going to talk about here. Intrinsic versus extrinsic value. Let's examine the intrinsic and extrinsic value of a binary option. Intrinsic value is defined as the in-the-money portion of the option value, or the value that the option would be worth upon expiration. Extrinsic value is defined as the worth assigned by external factors such as time and implied volatility. So, intrinsic and extrinsic value are very interesting when you're examining binary options. They're a little bit different than traditional options. Unlike traditional options where the intrinsic value increases in a linear fashion in conjunction with the underlying after it passes the at-the-money strike price, binary options increase in a digital fashion upon crossing the at-the-money strike price boundary. For example, when the price of the underlying passes the Nadex binary option at the money strike price, the intrinsic value goes from 0 to 100 instantly. So if we were looking at, say, 2010 calls on a different exchange, okay, they don't instantly go to their full value once they pass the 2010 strike price. Now this is just the intrinsic value side of it. Binary options do. The minute that it goes to 2011 or 2012 or 2013, it immediately goes to 100, the intrinsic part of that equation. When a Nadex binary option is trading at or below the strike price, meaning at the money or out of the money, then all of the value is intrinsic value. When a Nadex binary option is trading in the money, then the value is a combination of extrinsic and intrinsic value. What is interesting to note is that when the binary option is in the money, the extrinsic value is negative, which is why the trading value is less than $100 before expiration. So, Nadex binary premium is made up of intrinsic value, which is the value at expiration, and let's be clear with what this means. Okay, again, using that same example, 2010 binary option. At 2010 and 1 cent, okay, that binary option is worth $100 at expiration, period. At 2050, it's still worth $100. At 2017, it's still worth $100. But at 2009.99, it's worth 0. All right, that's at expiration. So the intrinsic value is, what would this be worth right this second if it expired right this second? Extrinsic value is time value and implied volatility. So what else is involved in that premium? Extrinsic value. So the extrinsic value is sort of the wild card in Nadex binary premium. Now, really quick, Nadex binary Greeks. We can apply these Greeks to Nadex binary options. And the definition of each Greek is as follows. Delta is the sensitivity of the binary option price to price changes in the underlying. So if for every 1 point that the binary option, that the underlying moves, if the delta is 50, then the underlying moves a half a point. Okay, it's the sensitivity of the binary option to price changes of the underlying. That is expressed in delta. Gamma is the sensitivity of the delta to price changes of the underlying. So as the underlying moves, what happens to the delta? Does it increase? Does it decrease? Etc. Theta is the sensitivity of the binary option price to the passage of time. Okay, as we get closer to expiration, what happens to the price of the binary option? That is expressed in theta. Vega is the sensitivity of the binary option price to changes in the applied volatility of the underlying. Applied volatility is a whole other factor. The volatility can rise and fall while you're holding that binary option without price even moving much. The Vega is an expression of how your binary option price responds to changes in implied volatility. And rho is the sensitivity of binary options to the price changes of the interest rate. We're not going to talk about rho much. So let's take a more detailed look at the extrinsic value components. Again, extrinsic value is represented as time value. So what goes into that? Well, the time until the spread expires, and then the volatility of the underlying, or the vega. So theta and vega make up the time value in extrinsic value. In a traditional option, you have to concern yourself with rho, but with binary options, it is almost never, if at all, going to affect the price of a binary option because interest rates are very rarely going to change while you're in a short-term binary option trade. So we're not going to discuss rho at all. I'm going to turn it over to Mike now to continue with the presentation. Let me just give you the mouse here, Mikey.
Thank you, Bob, for the very thorough introduction, as always. All right. Looks like I got the mouse. All right, guys, let's get into some specifics. This session, we're going to examine in depth how time or theta, volatility, implied volatility specifically, vega, market direction, and momentum affect the Nadex binary options when trading them in the money. I actually love trading these things when they're in the money, actually establishing positions when they're in the money. It's one of my favorite ways to trade them. We're only focusing on trading them in the money. What we did last week, and you can watch the recordings, as Bob said, we've talked about trading them out of the money and all the characteristics as it's related to out of the money. So if you didn't catch that one or want to go back and re-review it, please do, because it's important to understand it from both in the money perspective and out of the money. We're also mainly going to be focused on trading these from the long side when reviewing the Greeks for the point of simplicity, but everything we're covering applies from trading them from the short side. All right, so many traders overlook trading the binary options when they're in the money because they're solely focused on the reward to risk ratio. And they see that they are potentially taking on more risks than the reward that can be obtained by holding the binary option to expiration. This is especially true for binary options that are significantly in the money. So in order to have a chance of trading these binary options successfully, the trader needs to understand the market conditions that are best suited to initiate these kinds of trades. A well-rounded trader should consider all the market conditions, the required stop, and the projected target to determine the best binary option for each trade, not just looking at the final possible reward to risk. So once you understand the market conditions that can be beneficial to putting these on when they're in the money, you'll be one step closer to becoming a complete binary option trader. If you're just focused on looking at that risk sheet and saying, oh, look, I'm risking, I can make, let's see, I can make 35 and I'm risking 65. So, well, I'm not going to do that. Well, there's specific times you may want to do that. And you're only looking at the risk reward if you're going to hold these to expiration. I do not walk away from my terminal when I'm putting these on because I have a stop loss or a time I'm going to exit them way prior to expiration if my rules are violated or the market conditions become unsuitable for holding it. So I'm never taking on that full risk. I know what my reward is, but my risk and the risk reward is really skewed to looking at it the wrong way because I'm not ever going to take on that full risk. One of the things we're going to be going over is the market conditions and the times and the kinds of trades you want to consider using these for, and if those conditions change. Or, you know, I'll always have a mental stop level where whatever my strategy is that I use to get in this, I know where that strategy or that trade becomes invalid. Therefore, if I put on an in-the-money option, once my strategy is invalidated or my mental stop level is hit, I am exiting that trade. Yes, I will take a loss generally, not always, because it could have been in the money, it could have been, you know, sitting there and I could have absorbed some of that theta. Maybe I don't take a loss, maybe I do, but it's never going to be the full loss. So my true reward to risk is not what's shown on the screen, it's actually way better than what's shown on the screen. Here's our graph of the long binary that should say in the money. That's actually a typo. We're looking at it in the box down here. The orange section is in the money. Remember, it has to be some little bit above the at the money level. So it can't just be right to 2010, because if it ends right at 2010, at the money, its intrinsic value is still out is still 0 from the long side. Thank you for fixing that, Bob. On the fly. So this would be the way it would look like hypothetically with 15 minutes to go and a certain implied volatility. Remember the components that go into pricing these. We have the value of the underlying or indicative index, we have the timed expiration, and we have the implied volatility. So you can see that if we're trading this at 2011, you know, theoretically with 15 minutes to go, this could be maybe worth 58. If we're trading it at 2014, we might have to be trading it at about 90. And your bid offer, this is a theoretical value, so your bid offer or the bid ask are going to be on either side of this theoretical value. But this is the area we're focused on. Let's take a look at that extrinsic and intrinsic. Bob already gave you the rundown of that, how it shifts instantly intrinsically from 0 to 100 once it passes that strike price or at the money price. So intrinsically, a Nadex binary option is worth 100 the moment it is in the money. I just want to repeat that because it has an intrinsic value. That's not what you can trade it for the moment it becomes in the money. Why? Because that extrinsic value is negative. So that's why with a certain amount of time to expiration, it's actually cheaper than the $100 because the extrinsic value component subtracts itself from the $100, and that's how you get the theoretical price. When a trader is long and in the money binary option, every moment that passes helps the trader since the passing time lowers the extrinsic value, meaning it makes it less negative, which adds to the value. We looked at last week when it was out of the money, the theta or the time was hurting you. The longer it stayed out of the money, okay, because it was taking away from that extrinsic value which you actually purchased, and therefore the option was losing money the longer it stayed out of the money. This actually, the extrinsic value is becoming less negative, so you're capturing more of that pure intrinsic value. So it's getting closer and closer to that theoretical $100 value as long as it stays in the money and time passes. So if price action is either slowly trending further in the money or stagnant, it doesn't have to be trending, it could just be stagnant, and that option remains in the money, every minute that passes helps you. You don't need the market to move. That is critical. You know, if it just sits there somewhere in the money, even one tick above the at the money price, and gets there through expiration, that in the money option or that binary option is going to be worth the full $100. And as it gets closer and closer to expiration, this time decay actually accelerates. So you capture that time value faster and faster as it gets closer to expiration. So let's take a closer look really at how time affects the in the money binary option. So theta again is the time decay of the binary option. And we already covered how it would hurt the out of the money and it helps the in the money trader. So if the underlying price remains out of the money, then time is working against the trader. If it goes in the money, then time's now working for the trader. So when the trader's long the binary option and it's in the money, theta is positive. So a positive theta, if you take a positive number and add it to a negative number, the extrinsic value is negative, the extrinsic value becomes less and less negative, which means you're capturing more and more of that intrinsic value. And as I just said, the time decay increases rapidly as it approaches the expiration time. You know, when you're trading it out of the money and it's remaining out of the money and that expiration time is getting closer, that can be very tense for the trader because they're like, it's got to get in the money, else this thing's going to be zero. Well, it's when you're in the money, especially farther above the at the money or the strike price, and that time's actually getting closer and closer, you know, it's sort of the opposite. It's more exciting because you're seeing it get closer and closer to that full value, and you're more and more likely for that binary option to end up at the full value. Here's what happens. Price versus time now. Again, 2010 strike binary option. Here's the in the money portion. So let's take a look. If we're trading this with 60 minutes to go, let's say we put on this 2010 or 2010 strike price and we did it at 2012. With 60 minutes to go, and this is all assuming the implied volatility is not changing. We're holding that constant. We're varying time, but not varying the implied volatility. So we're at 2012. And let's pretend the market just goes stagnant. It's either after hours or lunchtime and there's nothing much going on. So let's just say the market's just trading back and forth across 2012. If we were to put this on with 60 minutes to go, we might have to pay $62, $63. Nothing else moves. Implied volatility doesn't change. Market still, we come back 30 minutes later. There's 30 minutes until expiration. Nothing else has changed, but now it's theoretically worth maybe 68. Okay? So, hey, great. Nothing else changed and it increased in value. We come back 15 minutes later when there's 15 minutes to go. It's now worth maybe 78. No, underlying still trading at 2012. Implied volatility did not change. The value's increasing. The only thing that's changing is time's getting closer to expiration. You come back with only 5 minutes to go. Now it's worth maybe 90. 1 minute to go, it's virtually worth its full value. So you can see if this does not change, it helps you. If it moves up slowly, closer and closer, let's say it's slowly creeping up a slower trend, not only are you getting the time value, but you're also getting the extrinsic value becomes less and less negative. So if you put it on with 60 minutes to go when it was at this 62 or 63, and then you come back maybe 45 minutes later, so there's 15 minutes to go, and it's now moved up to 2013. Look, you've not only gained the time value, you've gained the appreciation, which also further decreases extrinsic value, so you've captured more of that intrinsic value by the slow trend. Even if it were to slowly move against you, let's say you put it on here, and you came back with 5 minutes to go, and you put it on when price was 2012, and you came back with 5 minutes to go, and it had gone down to 2011. Okay, you didn't make as much, but it's still appreciated in value even though price went against you. As long as it remains in the money, you're safe. You do not want it, however, to go at or out of the money. Here's what the graph of theta looks like. And this graph, again, changes if implied volatility changes, which we will get into later, and it changes every minute. But this is roughly the way the curve looks. So when we're out of the money, below this 2010, look, theta is negative. Time is working against you. Anywhere in the money, see how it goes positive. So anywhere in this shaded area, time is working for you. Every minute that passes, it adds some value. It's adding a positive value to that negative extrinsic value, so the extrinsic value is getting smaller and smaller, which means you're capturing more of that pure intrinsic value as time passes. That's how the graph of theta looks. Theta versus time. Here's now how you can see it accelerate. So with 60 minutes to go, let's say we're at 2012, you're just capturing very little. 30 minutes to go, you're capturing more. 15 minutes to go, you're capturing more. 5 minutes to go, you're capturing even more. And 1 minute to go, where depending on where you are, you start capturing a lot of time. So you see how the rate of capture of that time, depending on where you are, accelerates. Now, if you're deep in the money, up here is deep in the money. When it's deep in the money, there's very little extrinsic value left at most times. So your theta is still going to remain low. Like if you're 2013, 5 minutes, 15 minutes, you're pretty deep in the money depending on the implied volatility. So your theta is going to remain pretty low. But let's say, look at this 2011 price. It's slightly in the money because your 2010 is a strike price. So as it gets closer and closer to expiration, it really starts accelerating. Why? Because if it remains at 2011, with 5 minutes to go, every minute that passes, it loses. You gain that time. It loses that extrinsic value, so you're really, really capturing it because the probability that it's going to remain in the money goes higher and higher, so it gets higher probabilities that it's actually going to be full value. And then, as with 1 minute to go, it really accelerates. That's how it looks like with time. So you can see, if you're looking at 1 hour or even 2 hours to go, initially you're going to be capturing very little of this theta. But as it gets closer and closer to expiration, you start capturing it more and more. So now that we've gone through a brief overview of this, let's take a look at the market conditions we want. So one of the best times to trade in the money binary option is during quieter or slowly trending market conditions. In the money binary options are not advised when the market could be headed into higher volatility conditions, especially when the underlying could begin a trend against the binary option position. It's highly recommended that the in the money binary option trader uses a significant support level. If you're going long, in the underlying, which is at or slightly above the strike price for a long trade. Conversely, for a short in the money binary option trade, it is recommended that there's a point of significant resistance in the underlying at or below the strike price. This is a key thing I want you guys to take away. Big secret. If you have a critical, let's just take it from the long side, a critical support level, and you can get that binary option strike price at or just below that significant support level, and the market's either holding steady above it or slowly trending, those are great times to consider putting on these binary options. Why? Because that support sort of provides a buffer. All right, it's like a floating device. Let's say you're in the water. It's like a buoy that keeps you above that option strike price, so you can sit and capture that time decay. It's also great because you know if you go below that support level and stay there, that's sort of like, okay, this is not good. That support level didn't hold. I should probably get out of this binary option, take my quick loss, take my loss. I'm not going to hold it to expiration. You know, that support level didn't hold. It's that line in the sand that tells you when you're wrong, which is really what you want for a binary option trade. So as long as it stays above that support level or tests that support level and then slowly starts trending back up, those are the kind of things you want. And if it does that in slow market conditions where you can just sit there and capture that theta, that's really what you're looking for. So, as I just said, these support resistance levels are a good idea because they provide the proven areas that our underlying should not trade beyond, thereby keeping the probabilities that the underlying remains trading in the money for the binary option. That's what you want. It gives you that clear line in the sand that you don't want the market to pass. These levels also provide the trader with a level that, should it be broken by the underlying signals, the trader should consider closing out the binary option trade, because you know you're probably wrong. Slowly trending markets or stagnant markets are ideal for placing in the money theta capture trades. That's what ITMTC stands for, TC, theta capture, or time capture trades, due to a tendency for implied volatility to remain stable or fall as the in-the-money binary option approaches expiration. So now we're going to look at how implied volatility affects this. Many times these kind of conditions can be found after a period of strongly trending market that has broken a key support or resistance level and is consolidated on the other side of that key level. These kind of consolidations after strong moves also tend to reduce the spread's implied volatility, which is extremely beneficial to the in-the-money theta capture trader. So you actually want implied volatility to be constant or going down. That implied volatility component is called the vega. So we want that steady to decreasing implied volatility. A decreasing implied volatility is the same as time passing and causes the binary option move closer to full intrinsic value. Well, why is that? Why would a decreasing implied volatility be the same as time passing? All right, when time passes for an in-the-money option, it has less probability that it's going to move back out of the money. Why? Because there's less time. There's less opportunity for it to do something drastic and move against you. Volatility or implied volatility is the same thing. Why? Because in lower volatility conditions, there's less likelihood that the market's going to have wider swings that could move it out of the money. So you want stable to lower implied volatility because it helps you. If the implied volatility is increasing and the underlying price remains stagnant, then the binary option price will increase and move farther away from its full intrinsic value, or it should say it will actually make the extrinsic value more negative and therefore reduce the price, which hurts you. Why? Because there's more probabilities that it could swing out of the money, and therefore it's not priced as highly. Now, as time approaches expiration, the effects of implied volatility changes shift closer to the binary option strike price. Let's look at this in graphs. Sometimes it's easier to look at this in graphs instead of words for me. So you can see this is the graph of Vega. What this means is for every 1% change in Vega going up, it actually makes the extrinsic value more negative, which hurts you. So if implied volatility goes up and you're in the money, it makes the extrinsic value more negative, and that's not what you want. If you remember from last week or in our recording, you actually want implied volatility to go up if you're trading it out of the money. You want implied volatility to go down if you're trading it in the money. Why? For every 1% decrease, what that would do is you have to flip this graph upside down because you're taking a negative of a negative. So if implied volatility is going down, it's subtracting a -1 from the extrinsic value, and therefore it's actually making the extrinsic value less negative, which is helping you. So you want implied volatility to stay the same or go down. Let me show it to you in a different way. So we put on this 2010 strike binary. Now we're holding time constant. Time is not changing. The only thing we're changing here is the implied volatility. So if we put this on at 2012 again, if implied volatility was 40% when we put it on, the markets aren't moving, so they've gone stagnant. And the market makers are lowering the implied volatility in their option model. If they take it down to 30%, nothing else changed, including even time. It went from maybe 65 to 70. They drop it to 20%. It goes to 80. They drop it to 10%. It goes to 90. So you can see how if implied volatility is going down and nothing else is changing, it's helping you. Conversely, if you put it on when the markets were at 10% and it's in the money, and then all of a sudden like some big announcement's going to come out, or something that they think it's going to get very volatile, or let's say underlying starts moving around. It's still around this 2012, but it's now 2011, 2014, 2011. It's starting to move back and forth rapidly. That will increase the implied volatility. So let's say we take a look at it and you put it on when it was at 10%. Now the market's getting more and more volatile. We take a look at it even a couple minutes later, and the only thing that changed was really implied volatility, and now they moved it up to 40%, and we still look at it right at that snapshot when it's trading at 2012. That option you might have put on at $90 has decreased in value to $65. Even though price, yes, it's been moving, but we're still looking at it right when it's 2012, the implied volatility hurts you. You do not want to have these on in rising implied volatility conditions because it's working against you. Why? There's more likelihood that it could go out of the money. There's also more likelihood that it can go further in the money, but it gets more unpredictable. That's why the price drops. Here's how the Vega curve changes with time. So you can see as time gets closer and closer to expiration, the volatility gets closer and closer to the at-the-money strike price. So if you're trading down here at 2011, as time approaches zero or closer and closer to expiration, any implied volatility changes, it doesn't hurt you that much when it's 60 minutes to go, but it can hurt you a lot with 5 minutes or 1 minute to go. Okay? Whereas if you're further and further in the money, okay, let's take 2016. So we're pretty deep in the money. With 60 minutes to go, implied volatility changes are going to hurt you a fair amount. However, look, with 5 minutes to go or 1 minute to go, even if it goes way up, it's not going to hurt you a lot because there's so little time to expiration and it's so far in the money. So that's one of the things you have to take away from this. If it's close to this at the money price and you're getting close to expiration and implied volatility starts changing, it can drastically hurt you. Let's take a look at delta. So it's important that the trader understands the delta of trading an in-the-money binary option. The delta is the amount the binary option price will move in relationship to a 1-point move of the underlying. Bob covered this in the introduction. So if the delta is 0.2, then the binary option price will increase or decrease 1/5 or 20% as much as the price of the underlying. Delta of a binary option varies greatly depending on the time until expiration and the distance the underlying is from the strike price. The farther in the money from the strike price, the lower the delta. When the binary option gets closer to the strike price, the delta increases. This is especially true when the binary option is close to at the money and as the expiration time approaches. Here's a graph of the delta versus time. So you can see as your delta, if you're further in the money, the delta is not changing that much. It's pretty close to zero. Why? Because the price movement isn't going to move. The underlying price movement does not change the option price that much. But let's look at 2011. If you're trading this and it's 2011 with 60 minutes to go and it moves up to 2012, you'll roughly add, about 10 to the price. So it could go like from 60 to 70. As with 15 minutes to go, let's say it was 20. If the underlying moved from 2011 to 2012, instead of going 60 to 70, it might go 60 to 75. With 5 minutes to go, it might go, and you were trading 2011 and it went to 2012, it would go from 60 to 80. It gets more and more extreme. You can see what happens, though, if you're right at the money, because it does not know what side it's going on. So with very little time left, you can either gain or lose a lot of value with slight movements in this. That's what you have to learn, that as you're getting close to expiration, if it's right near this at-the-money strike price, the option price is going to change drastically when there's very little time left. We've looked at some optimal conditions. Let's flip it on its head and rephrase them in non-optimal conditions. So, we're not looking to trade in-the-money binary options during very volatile market conditions, especially with increasing implied volatility. It's going to hurt you. Not only does it decrease the probabilities that could finish in the money, rising implied volatility actually reduces the price of these options, so the price movement hurts you. We are not looking to enter into these in-the-money options when the underlying is trending against the position. We want the price to be stable and holding or trending for us. So if we're long, we want it trending up or staying stable. If we're short a binary, we want it trending down. It does not have to be trending quickly. It's actually better if it trends slowly because that holds the implied volatility stable. Significantly increasing implied volatility combined with an in-the-money binary option moving towards the at-the-money price can be a very bad combination of factors, and it is suggested that the in-the-money binary option be exited if a key support level, resistance level is broken. If you start to see it trending and implied volatility going up and it's moving towards that at-the-money price, that's not a good combination for an in-the-money binary option trader. You're not going to be getting a time capture. Your probabilities are going down. If it goes out of the money, then that now time's working against you. So you've got to think of those things. So examples of non-optimal conditions. Establishing an in-the-money theta capture crude oil Nadex binary trade that expires at 11 a.m. at 10:20 before the release of crude oil inventories. Price might be stagnant, but generally implied volatility is going up. And once those inventory reports come out, price can start trending. And it might start trending against you. So bad combination because you expect implied volatility to go up and you could get in severely trending markets. You're better to wait for that to come out especially if it comes out and implied volatility starts dropping out and it's trending in your direction, now you put it on, but not right before. Putting on an in-the-money theta capture US 500 binary that expires at 4:15 p.m. at 8 a.m. when the non-farm payrolls is due to be released at 8:30. Why? You don't know where this market's going. You're better to see it start getting a direction and then maybe even trade something out of the money using those strategies. And then, hey, it starts trending, and hey, now we're going into lunch. We've had a good trend all morning. You know, it's established a good trend because of those payroll numbers. Now we're going into lunchtime where we've trended up. I got a great support level. Implied volatility is starting to come down. Now I can put it on that stable to slowly trending conditions. That would be a better time to introduce an in-the-money theta capture binary. Let me turn it back over to Bob, and he'll walk you through an optimal example.
Thank you, Mike. So, optimal example. Here's some optimal conditions when a trader might consider an in-the-money binary option trade. The underlying has moved the expected true range distance and is consolidating just above a major significant level. Now, a lot of the things I'm going to mention here are specifically, they're aligned with our strategies, but we're trying to make them as generic as possible because, as I said in the risk disclaimer, we're not trying to sell you anything. But the underlying has moved the expected true range distance and it's consolidating just above a major significant level, which is one of our proprietary things. Implied volatility is still relatively high and beginning to fall, and there is still nearly 2 hours left in the trading day. Let's review a path trading setup that would be suitable for trading an in-the-money binary option. So here we have a chart. US 500 triggers a path trading double bottom pattern. Again, the reason we call it a path trading double bottom is we've got specific rules around double bottoms and double tops. This happened to be one that is a trigger. Falling implied volatility with price reversing late in the trading day. A single in-the-money binary with a strike price of 1992 was entered at a price of 70. So again, if you entered at a price of 70, you know the other side of it is 30, right? So you've got $70 worth of risk if you were to do one contract. And here, Jamuel is the guaranteed risk I was talking about. You've got a maximum risk of the amount you paid in this particular instance. So it was entered at a price of 70. This particular trade quickly went to target. Now, not all of them do. Even though there was 35 minutes remaining until expiration, we removed the trade at 95 since our target price was reached. So here you can see the run up straight to our target price. We had a target price that was pretty close. I mean, it wasn't that far off, relatively speaking, but late in the day, on a chart like this, you see those kind of moves, and especially if it's an up move, you usually see that kind of situation in a declining vol environment because it is late in the day. If it's a down move, that can actually be the reverse. Now you can see here, 1992, the trade went all the way up to basically 1999, 2000 on the high here, but we still exited this particular trade, even because for the extra $5, we had reached our target. That's what we were trying to do. So when we reach a target, we exit a trade. We don't try and squeeze out a couple more dollars, 10 more dollars, 5 more dollars per contract, because the target itself on the pattern that triggered the trade has been completed. So this is a good example of when an in-the-money binary would have been a high probability trade for us, and we took in all that theta. Bought it at 70, sold it at 95. Had the trade reversed, we would have exited the trade. We would not have accepted the entire $70 worth of risk. Now, having said that, there can be times where there's an event and a price completely reverses. You still have to theoretically take the trade knowing you could lose that full $70. But in the course of a normal trading day with no abstract outside forces like terrorism or something like that could move the market really quickly, we would have exited that trade prior to losing the $70, and it would have been somewhere inside a path trading stop that we would have put on the double bottom on the downside. But this particular one went to target quickly, and we exited the trade at 95, getting out for a profit of $25 in this particular trade per contract. So in this webinar, we covered various aspects of trading in the money Nadex binary options. We examined how some of the Greeks affect the binary options, and we also looked at the optimal and non-optimal market conditions, which can help a trader determine when to trade in the money binary options. You will probably need to review this information multiple times, and then determine how this information can work to further help you successfully trade in the money binary options with your trading strategies. A lot of traders wouldn't take it in the money binary because of that out of whack, or at least visually out of whack, reward to risk on the ticket. But when you know the way the particular conditions, market conditions, affect the price of the binary options, sometimes this is actually a much more responsible trade to take. Sure, in the example I showed you, you could have bought something out of the money with that big move up in toward the end of the day, but we were playing this for that extrinsic value, that theta decay, to take the money in, and it made it a more reliable trade and a more reliable choice in this particular instance. So before we stick around for questions, which we're happy to do, we've got a couple in there already. Please follow us on Twitter, like us on Facebook, or at @path_trading on Twitter. Obviously, Facebook, pathtradingpartners.com. Go to our website, sign up for all the free stuff on there. Again, if you want to buy something great, you don't have to. We don't inundate your mailbox with emails. That's not something we do. If we have something valuable to show you, we show it to you. I think we've sent out 2 emails in the last 5 or 6 months. So sign up for the free stuff, check it all out, and please listen to our podcast, The Money Path, which can be found on our website as well. It's iPhone, Android compatible. That's got other stuff in there besides some of the stuff we do here. So, questions. First one is from Stephen early on. He wanted to play the part of Eliza Doolittle and see if we could turn him into an excellent trader. Stephen, sign up. We'd love to give that a shot. Right? We'd love to make you an excellent trader. That's kind of what we do. But as is the case in My Fair Lady, there was time involved, and there was work involved, and there was failure involved before she became Mrs. Higgins. So hopefully you're willing to do that as well. Javier, you're welcome. Chris says good information. Do you have a general rule about stop loss then? Like 1-to-1, if your target is $20 profit, you generally set a stop loss at $20 loss. Okay. That's a great question. Let me read the whole question. If your target is a $20 profit, do you generally set a stop loss at a $20 loss, or based more on indicators, support, resistance levels? Mike and I don't use indicators or support and resistance levels. We use price action. Our stop is the first thing we look for. We don't look for the target first. So we look for, like you say, if you have a $20 target, do you make it a $20 loss? No. If our target is more than our stop, we will generally do 1-to-1. Usually we look for better than that. There are instances where the probabilities are really high where we'll even violate that 1-to-1 rule. But as a general rule, 1-to-1 or better. I prefer 2-to-1. In this particular case, setting your stop at the price that your target is really, it's really an amateur thing to do. The same price action or the same method that gives you your target, to a certain degree, should be employed to use your stop. We know a lot of traders that use like a fixed dollar amount as a stop, or a fixed number of ticks if they're looking at the underlying, or a fixed number of pips if they're trading FX, right? That's really not a professional way of doing things. When you look at it from a professional, sort of with professional glasses on, if you're charting to find your entries, you have to chart to find your stops as well. And if they don't match up within the reward to risk that suits what you're doing, then you have to pass on the trade. You don't just tighten your stop up to make it fit. If you do that, the reward to risk rule is useless. Because really, if the chart is showing you the risk on this trade is 70 ticks, or $100 if you convert it into money, and you decide, well, I could make $50 on this trade, I'd really like that $50, and you go ahead and say, well, I'm going to move my stop up so I'm within my reward to risk, you will lose so much more often than your method is really intended to, that you'll just be in a really bad situation in the long run. So if you guys use price action to trade, which Mike and I both do, you should use price action to find your stop levels as well. And if your stop level doesn't fit your reward to risk, you don't adjust your stop and you don't adjust your target. You adjust your action by not taking the trade. Remember, you have to trade to make money, but you also have to trade to lose money. So that's a bad trade in general. I don't know, Mike, if you wanted to answer to add to that, but I'm going to read the next question.
No, you pretty much covered it at this point.
Well, this is to you, Mike. When trading in the money, why does it matter that the implied volatility increases when at expiration you get full value, regardless of the price point moving? My first webinar, pardon my ignorance. That is not a dumb question, Llewellyn. Go ahead, Mike.
I will give you an example because you're not, from my perspective, you don't always plan on holding these things until expiration. Yes, if it does expire, still in the money, you will collect full value. Implied volatility rising actually decreases the price. So if you have to exit early, if price stayed the same and implied volatility went up and you had to exit the trade early, you are actually going to lose money. I've actually seen the case where implied volatility has gone up based off of some event. The price has still gone in your direction, and I've had to exit the trade early and pretty much had to take it off right where I put it on, even though an hour had passed because the rising implied volatility conditions. And also, if implied volatility is rising, it generally either underlying volatility is rising or is expected to be rising, which also decreases the probability that it's in the money. And is close, if you're doing this very close to expiration and it's getting close to that trading near that at the money price, you can get it. It essentially turns into gambling for me because you don't know which side it's going to end up on. You're losing money because that implied volatility is going up. Now, if it flips the other side out of the money, that time decay is no longer working for you. It can compound the issues. So I'm looking more to put these on in stable to decreasing implied volatility conditions because it lends to the probabilities, and if I have to exit early, I can take that off. For example, Bob went over an optimal example trade. In that example trade, the implied volatility really didn't change much. But if that had moved up rapidly to our target and implied volatility had gone way up, then we wouldn't have made much, or we could have even broken even on that trade. And then let's say it went up and then retraced. So it hit our target, we didn't take it off, and then it started to drop back down. We could have turned a winning trade into a losing trade because it's the wrong kind of conditions you want to really be considering to put on an in-the-money trade.
Well, and think about what volatility is. Okay, volatility is either the appearance or the prediction of widened ranges. So even if something is deep in the money, yeah, if volatility is rising quickly, yeah, even, go ahead, Mike.
Can I go back to this slide?
Yeah, sure, of course.
Now, if it's very deep in the money, that's why I showed you this slide. Let's see. All right. Very deep in the money. Here's Vega versus time. So let's say we put on a 2010, and now it's 2015, and we have very little time left, 5 minutes left. All right, even if implied volatility is going way up, we're far enough in there it's not going to hurt the price that much. Now, price could still collapse or move very rapidly. We can't control that. But just the changing implied volatility, the deeper we are in the money with little time left, is not going to affect the price. It just depends how far in the money you are. See, even if this is a 2010, even with, let's say you're at 2013 with 5 minutes to go, drastic changes in implied volatility can still affect the price pretty rapidly. So if you consider that deep in the money, which I don't, that's something to consider. It just depends on where you are in the curve. Most people have not seen the graphs like this, so they don't know how it's going to change relative to the strike price.
Llewellyn is saying yes, yes, I see, Mike. I don't know if you can see the questions, but anything else, guys? I'm going to go ahead and put the please listen to our podcast slide up again. I love our podcast.
See, one of the points of these graphs, and this is why you might want to watch things multiple times and watch some of this, go back and especially in a demo account, play with, put on these different in the money versus out of the money at different conditions, and then start watching them and say, oh, I see what Mike and Bob mean, because now I can go back and look at that graph again and see how it really applies. All right, what's deep in the money? What's close to at the money? And volatility is rising. How is that really putting this all together? Those graphs start making more sense when you've taking the theoretical, start to work with it in the real, and then come back and say, okay, here's what I've seen happen. Now I really understand why that graph looks that way.
Any other questions, guys? We're happy to stay for a few minutes, but if we don't see any questions coming in, we're going to let you guys have your dinner or drink or whatever it is you do. Thanks, Chris. Appreciate that. The at the money is always listed. All you have to do, Llewellyn, to see the at the money is look at where the index is and look at the strike prices. So if the S&P is trading at 2005, then the closest strike price to 2005 would be the at the money, and so on. Go ahead, Mike.
And it doesn't always have to be. It could be. It could be right in the middle. Let's say there's a 20. Let's just say there's a 2005 and a 2006 binary, and it's trading at 2005 and a half. Technically, one's in the money, one's out of the money. There is no exactly at the money at that point. Okay, so you have your fixed strike prices in the markets. Now, if the market then drops to 2005, the 2005 is now exactly at the money. The 2006 is still in the money. If the market drops to 2004, then the 2005 and the 2006 are both. Did I reverse that? Did I say the wrong thing, Bob?
I don't think so.
So I wish I had a slide up for this. So if we're at 2005 and we're trading a 2005 strike price option, and the indicative index is right at 2005, then that's at the money. If the indicative index goes to 2006, then we're now in the money. If it goes to 2004, we're now out of the money. If it's, depending on what your combination of strike prices are, based off where the indicative index is trading, then you might have some options at the money, or you might just have them all either in the money or out of the money.
Right. There's no designation next to it that says at the money, right? You just have to use what we've taught you in here to see which ones are at the money, which ones are out, and which ones are in.
And you don't always, at the money is a construct of, and it applies to all options, but it's really the tipping point, especially for the binaries. That is the line in the sand of the intrinsic value going from 0 to 100 when it crosses at the money.
This is why go ahead, Mike, I'm sorry.
I was going to say that's the most important takeaway of at the money, and that at the money, if it ends up dead on at the money, that's not in the money on expiration.
This is why we're fans of Nadex for being a sort of a training ground. If you ever want to go into other types of options down the road, what we've taught here, along with some of our other archived webinars and the stuff we'll be doing in the future for you, is really a training ground for options. You've got to remember, these are binary options, and the things that Mike has gone into and I've gone into in here are options concepts. So you're actually learning options right now, but yet you've got this limited risk, limited reward, controlled, less expensive environment that's regulated. So that's really a big deal. That's why we like to see you guys here. So that's why we say there are no dumb questions, Llewellyn. Appreciate it. All right, anything else, guys? All right, again, sign up at Path Trading Partners, download all the free stuff. We'll probably put some more free stuff up there at some point. We've been trading a lot, though. Listen to our podcast. That'll be some funny, I almost cussed. Sorry, Nadex. That'll be some funny
stuff.
I wasn't going to say stuff. All right, guys. Go have a drink. I'm going to. Cheers, everybody. We'll talk to you soon. Thanks, Nadex. Appreciate it.
Thanks, everyone. I'll talk to you guys soon.